Morning. For last week, it was a recorded session. I hope you all have no questions from last week. If you have any questions, I'll give you a minute to clarify. We covered budgets, performance evaluations last week, and also asset accounting. Right, so when you purchase an asset, how do you classify? Right? If you all could remember the three categories, there were the trading portfolio, or FVTPI, FVOCI, fair value through profit or loss, fair value through other comprehensive income, and held to maturity. Those were the three categories under IFRS 9. So that's the latest classification. Any questions from last week? We moved on to performance appraisals. Evaluating performance, and also we did budgets, right? Incremental budgets, zero-based budgets. So if you have no questions, we can move on. Okay, right, so no questions. Now, about a couple of weeks ago, we covered interest rates. Right, interest rates, in sense, we did mainly bonds, fixed income securities. If you all could remember, we analyzed the fluctuation of a bond price when interest rates change. So what happens when interest rates go down? Bond prices will normally increase, right? That's because there is an inverse relationship between interest rates or the yield and bond prices. Now, what normally happens when interest rates are brought down, when the central bank is easing monetary policy, like what is happening right now in Sri Lanka? Liquidity is being injected. Right? The central bank is purchasing treasury bills and bonds. Government securities are being purchased by the central bank. So when the central bank purchases government securities, they release money to the economy. That increases money supply. When supply goes up, interest rates will come down. Right? So why is the central bank doing it? Why are they doing that? And also, they've reduced the statutory reserve requirement, reduced interest rates. And so that's all of those are indications that the central bank is easing monetary policy. Now, the current situation in the country and also across the world, right, is such that monetary policy had to be eased. There is no way out. So this was the only solution to tackle the slowdown in the economy, to avoid the financial crisis. This had to be done. Right. So now, what are the implications of reducing interest rates? What happens in a country when interest rates are reduced? Usually consumption goes up, right? Yeah, and also when we have money, we might start. Excuse. Sorry, that's not corona. Don't worry. When interest rates are brought down, consumption starts increasing. There'll be a boom in construction, right? Not only construction, in consumption, sorry. Now, when consumption increases, people will start spending more on consumer durables, maybe capital goods. And so you'll start investing or buying vehicles, maybe. Now, when that happens, right, when you purchase a vehicle, because we don't produce our own vehicles, we import vehicles, there'll be a demand for foreign exchange, isn't it? Now, to purchase a vehicle, let's say you want to purchase a brand new Toyota, right, from Japan. You will have to pay in foreign currency, foreign exchange, right? So you'll have to buy yen to purchase this. Right. So that when interest rates go down, when rates start going down, more and more people will start maybe consuming more, purchasing more and more vehicles. Right now, of course, there is an import ban, restriction on imports. Vehicle imports are not happening. But if those were not considered, if vehicle imports were happening, perhaps, or electronic goods import were happening, we might spend more on maybe vehicles, cameras, and all that, which are imported. So for us to import, we need foreign exchange. Yeah. And the lower the interest rates goes, the more we might start consuming in this kind of goods, right? Consumer durables, import stuff will also increase. So the key is there is a link between interest rates and also the foreign exchange rate, isn't it? When interest rates go down, we start importing more, perhaps. And when interest rates go up, we start importing less, right? So this means that we might also start importing gold when interest rates go down. This means that there is a link between all types of markets. So it's not that you can look at interest rates alone, or you can't even look at foreign exchange rates alone. You can't look at commodity markets alone. You'll have to look at the entire package. One market has an impact on another market, because markets are not watertight compartments. And what happens in one market will have a definite impact on another market. A classic example is the COVID-19 outbreak in China. What happened in the Chinese market had a direct impact on the rest of the world. Okay, so it's a health crisis that has now boiled down to a financial crisis in the world, across the world. So it's very interesting that markets have links. So interest rates are definitely linked to exchange rates or even commodity prices or any market that you could think of. So today's topic is on foreign exchange. Now, I'm not sure whether any of you have done foreign exchange before. Well, if any of you have done foreign exchange, can you all please type on chat and tell me whether you have done or you have not done, so that I have an understanding of where I should pitch this. Right, I need to know whether I should cover the basics, or if all of you are very thorough with foreign exchange, we can move on to the next topic. Now, if this was a classroom, I could have asked each of you, but I don't have that luxury right now. Can you all please type on chat whether you want an in-depth understanding of foreign exchange, or whether you all are thorough with foreign exchange? How many? Yes, not done. Okay, Jared, thank you. How about the others? Anyway, right. So let me just assume that none of you have done foreign exchange, right? And we will be covering foreign exchange from the basics. Now, the first thing is, I don't believe that none of you have done foreign exchange. That I don't believe. Why? Because if you have purchased a loaf of bread, right, or a pen, then you have done foreign exchange. Now, I don't believe that none of you all have never purchased a loaf of bread. At some point of time, you would have purchased something. So if you have purchased anything in your life, not a loaf of bread, but anything, it could be a t-shirt or whatever you can think of, that's as good as doing foreign exchange. Right? It's just the same, identical thing. If you know how to purchase a piece of bread, a loaf of bread, or a pen, you're thorough with foreign exchange. There is nothing new to learn. Right? So all of you have, in fact, done foreign exchange. You have covered foreign exchange, and you all are masters of foreign exchange. Right? I really mean it. All of you are masters of foreign exchange. You never realized it. So there is nothing new to learn. Nothing new. By the way, We discussed the links between interest rates and exchange rates now. Now, the classic example I can quote is, right now there is a country in the world which had to abandon its currency. About 10 years ago, it had to drop its currency. Its currency became worthless. Can any one of you tell me what the country is? A country which had to abandon its currency. Its own currency had to be dropped. They're not using it anymore. Very good. Fantastic. It is Zimbabwe, right? So what was the reason? Why did the Zimbabwe dollar go out of favor? No one is using the Zimbabwe dollar. It has become a collector's item. Why? Fantastic. Hyperinflation, right? So what is the link, Nagveshman? Or anyone? Yeah, right. Yeah. That itself, it was hyperinflation, right? So inflation led to the currency being dropped. Classic example of interest rates and exchange rates moving hand in hand. Not only that, any market will have an impact on another market. Right? That's unavoidable. So you can't study markets in isolation. If you are doing markets, if you are going to deep dive into markets, you need to have an understanding of all markets. At interest rate markets, bond markets, foreign exchange markets, equity markets, commodity markets, all of these, derivative markets, all of these are interlinked. Right? One market will not exist independent of the other. Right. So getting back to Zimbabwe, what went wrong? Hyperinflation. Very good. Any idea what was the Zimbabwe dollar reading when it was dropped? What was it trading at? How much is $1 US in Zimbabwe dollars? $1 US is how many Zimbabwe dollars? How much is that, Ezra? And good guess. Yeah, it was 35. Right? 35. So actually, a little more than that. 35 million. And a little beyond that will be 35 billion. Then comes billion. And 35. What is this called? It's called quadrillion. And so this is where the Zimbabwe dollar ended up. $1 US was 35 quadrillion Zimbabwe dollars. Right. Actually, this happened after the currency strengthened. Towards the end, the currency strengthened. Before that, there were more zeros. It went up 23 zeros. 23 zeros. The board is not long enough for me to write it down. Yeah. Even 35 quadrillion. Let's assume you live for 100 years, right? And from the time of birth, every second you count as 1, 2, 3, 4, 5, likewise. Right? Every second you give a number. Right? So 100 years into 30 seconds does not come to this. Right? You try, it will not come to that. I don't think it will come. So it's 60 seconds. There's 60 numbers for a minute into 60 minutes. That's 1 hour into 24 hours is 1 day into 365 is 1 year into 100 years, right? So every second, if you start counting from the time you were born until you're 100 years old, you will still not get to 35 quadrillion. So what happened in Zimbabwe? What happened? Why did it go up to 35 quadrillion? A lifetime is not enough for you all to count 35 quadrillion. What happened? It got so bad that the Zimbabwe government had to issue a $1 million note. $1 million. Zimbabwe dollars. Yeah. So if at all you all we have a intention, a dream of becoming a millionaire or a quadrillionaire, the easiest thing is to take $1. Just $1 and go to Zimbabwe. Overnight you become a quadrillionaire. You have to work hard now. What went wrong? Why did it go to these levels? Hyperinflation, as you rightly said. So what was the link between inflation and the exchange rate? What pushed the exchange rate to these levels? Zimbabwe, as you all know, had inflation of around 200, maybe up to 500%, right? So overnight, the price tended to double. What you bought today for X will be 2X tomorrow. It was that bad in Zimbabwe. How did the government control inflation? They started printing money. Right? Now Zimbabwe is a country where almost everything is imported. Whatever they consume is imported. Hardly anything is produced locally. So to import, they need foreign exchange. Right? Now, when there was hyperinflation, the government started printing money, pumping money into the economy. So there was more money circulating. When money circulation increases, interest rates, the price of money will drop. Right? So when interest rates dropped, borrowing cost became cheaper, and the citizens of Zimbabwe started consuming more and more. Now, when they don't save, by the way, and Zimbabweans don't save. They eat and drink like there is no tomorrow. So these guys started consuming more and more. Now, for them to consume, whatever they consume is imported, right? Because Zimbabwe hardly produces anything. Now, the imports, the amount of imports started going up. Right? Now, when imports go up, the exchange rate also goes up because the demand for dollars will increase when imports go up, right? That means the price of the dollar started increasing. So they started consuming more and more, meaning importing more and more. When they imported more and more, the exchange rate started going up. Right? So the price of the goods that were imported in Zimbabwe dollar terms started going up. Now, when the price started going up, inflation also goes up. So inflation went up with the exchange rate. When inflation goes up, the Zimbabwe government, again, how did they tackle it? They started printing money. Right? So they printed money and brought interest rates down. Now, when interest rates went down, again, the citizens of Zimbabwe went on a spending spree. They started importing more and more, again, consuming more, therefore importing more. When they imported more, the exchange rate, the demand for the foreign exchange or demand for dollars increased again. Right? And the exchange rate weakened. Right? The dollar strengthened against the local currency. So the dollar went up. When the dollar goes up, again, once again, the price of imported stuff, imported goods will also go up. When the price jumps, they have to, the inflation will also go up. So when inflation goes up, to address this, the Zimbabwe government again printed money. So again and again, the Zimbabwe government kept printing money. And all the printed money was used to bring down interest rates and consume more, meaning import more. So that drove up the exchange rate. Yeah. So this was a cycle which was very bad. Therefore, it's called a vicious cycle. Right? So hyperinflation in Zimbabwe or money printing in Zimbabwe led to what is called a vicious cycle. And it's a deadly cycle. It ended up by Zimbabwe being forced to drop their currency. They had to remove Zimbabwe dollar from circulation. Now, in Zimbabwe, they sell currencies by wheelbarrow loads. Right? You go to Zimbabwe, you get currencies in wheelbarrows. There are no takers. No one wants a Zimbabwe dollar. And you get money on the street. People start selling money. The cash, physical notes are being sold on the street. So to buy a loaf of bread in Zimbabwe, you have to take a truckload of money. Even that is not enough. Right? Maybe 2 or 3 truckloads of money, but still not enough. So bad. Okay, so remember, money printing or hyperinflation. Money printing can lead to hyperinflation, and it can ruin an economy. It can ruin a currency. Classic example. Right? This is pure mismanagement by the Zimbabwe government. Now, during a crisis, it is fair enough. The entire world is printing money, so there is nothing wrong with that. But money printing, beyond a certain point, can be disastrous if it's used for mismanagement or to artificially bring down interest rates, right? So that is the link between interest rates and exchange rates. All right. Now, exchange rate is something that will not hit you at once. Sorry, interest rates are not something that will hit you at once. It is a slow killer. It's like diabetics. Whereas exchange rate is something that will pinch you instantly. It's like a heart attack, you die instantly. All right. So any questions up to now? Hope you understood. Any questions? No questions? All right, excellent. It means either you understood everything or you understood nothing. Yeah. Okay, so let's move on to foreign exchange. Now, don't panic because the Sri Lankan rupee is still at about 180. Again at 180. So there is a long way for us to go. Yeah, nowhere close to this. All right. So foreign exchange markets and instruments. I will start from the basic, very basic. Now, what is foreign exchange? And why do foreign exchange markets exist? Now, foreign exchange is a market in which the currency of one country is exchanged for the currency of another country. Yeah. Okay. I mentioned that I'm not sure whether you saw the Zimbabwe dollar currency reading. It's 35 quadrillion, so that's 35 and 15 zeros. 35 followed by 15 zeros. Right. I mentioned that there's absolutely no difference in buying a loaf of bread or a mango or buying foreign exchange. Why? Because if you say one mango is 100 rupees, right? So this is the price of one mango against the rupee. It is 100. Now, instead of mango, if a mango was called a dollar, this will be dollar against the rupee is 100. And so there is absolutely no difference between these two. They are identical. That's what I meant. Yeah. So if you know to buy a mango, you know to buy foreign exchange. You know foreign exchange. It's as simple as that. Okay. So why do you need foreign exchange? Why foreign exchange? One question I always had was, why can't the entire world use one currency? Why can't the entire world use one currency, just one currency? Do you all have any reasons? What do you think? Why can't the entire world use one currency? Why are we using different currencies? Sri Lankan rupee, US dollar, sterling pound, euro, yen, yuan, Australian dollar, New Zealand dollar, Canadian dollar, Hong Kong dollar. So why all sorts of currencies? Why can't we use just one currency? Now, what is the currency that is being used by the IMF? What is their currency called? Because IMF does all their transactions in a certain currency. It's not called the dollar. What is it called? IMF currency is called? Very good. SDR. What does SDR stand for? Special drawing rights. Fantastic. Right. So the IMF does all their transactions in a currency called special drawing rights. So it's a basket of currency that consists of the US dollar, sterling, yen, Chinese yuan, right, and the euro. The four major currencies in the world. Actually, five. With the Chinese yuan, they have five, right? So it's a basket of currencies that decide on the value of the SDR. Very good, Dinesh. Economic strengths are different. Yeah. So why can't the entire world use one currency? If the entire world had used one currency, we could have skipped today's lesson, right? There is absolutely no point of doing foreign exchange if the whole world is using one currency. So we don't have to study foreign exchange if that was the case. But unfortunately, it is not the case. So we have to do foreign exchange. Yes. Economic strengths of countries are very different. Very true. Right. So what it means is, if you take countries like the US and a country like Zimbabwe, they're poles apart in terms of economic strength. Now, the implication of that is a country like Zimbabwe. So look at what Zimbabwe did, right? They had they printed money, so you lose monetary policy independence. And if the entire world was using one currency, you will lose monetary policy independence. Like Zimbabwe had the choice of deciding what to do. If the whole world was using one currency, they could never have printed money. Now, take for example the Eurozone. Greece defaulted on their bonds. Now that happened in the Eurozone. So why couldn't Greece, now see, look at Zimbabwe, right? A country will never default on its own debt. No? So Zimbabwe also, if they had issued debt, right? The government had issued debt in Zimbabwe dollars, they would never have default. But Greece defaulted on their own currency, on euros. Right now, currency in Greece is euros, but they still defaulted. Why? Why did Greece default on euros? It's never supposed to happen, right? But it happened in Greece. What happened? Why is that? Why was that different? Any idea? The Brexit never happened, right? So Greece is still part of the Eurozone. So Greece defaulted, then they were saying some of the other countries like Italy was also in trouble, but they never defaulted. What happened in the case of Greece? They defaulted on their own currency. Why? Because Greece ran short of euros. Right? Now, before the euro was adopted, Greece was using a currency called drachma, the Greek drachma, and that was abolished. And the entire 17 or 19 countries in eurozone started using euros. Right? The euro. And who decides on whether to print euros or not? Now, if Greece ran short of euros, the only thing, the easiest thing they could have done was to print euros and give it to investors. Right? They will never default. But in the case of Greece, their central bank, the Greek central bank, cannot print euros. It is done by the ECB, which is beyond their control. And so only ECB can decide whether to print euros or not. Greece on their own cannot decide to print euros. Okay. So when the ECB makes decisions, they look not only at Greece, but the entire region. Regional countries, they'll have to look at the implications printing money will have on Germany, France, Italy, and the rest of Europe. Right, so Greece did not have the independence to print money. Now, independence to print money is part of monetary policy. Greece never had that. That's why they defaulted. Then Argentina defaulted on some of their debt. Argentina defaulted. That was also for the similar reason. They can't print money. Print money means you increase money supply, you bring down interest rates and all that. That independence will be lost if you use a common currency. Right? Okay, then good reasons. Yeah, economic strength. So if country is economically strong, most of the problems are minimized. Right? The country of Japan has continuous surpluses. They don't have an issue of, they in fact have deflation. And so their problem is to create inflation, encourage people to start spending. Economic strengths of different countries vary. Then you lose monetary policy independence. What else? What are the other reasons? Why can't the entire world use one currency? Why is everyone using their own currencies? But politics also plays a part, right? Now imagine asking a country like Russia to use the US dollar as their currency. It will never happen for political reasons. Okay. So for these reasons, the entire world will not use a common currency. Right. So let's move on. Why foreign exchange? If you want to make a capital transaction or a current account transaction with an overseas country, you will have to use foreign exchange. Right? If you want to import from the US or any other country, or if you want to invest in another country, you will have to use foreign exchange. You will have to invest in their own currency. You can't invest in Sri Lankan rupees. When a country buys goods and services or invests in another country, the country has to obtain some of the other country's currency to make the transaction. So foreign exchange market are around the clock markets. They work not 24/7, but in fact almost 24/5, right? Foreign exchange markets are in operation on all 5 days of the week, from it goes from the east to the west. When New Zealand, there's another country before that which opens. From that time up to America close, the US markets close, they're in operation. So there's a very small gap in between. So it's virtually an around the clock market, except weekends, the market is in operation, right? And there is no central location. You can't say that the foreign exchange market operates from Germany or the US Right? There is no central location. It's over the counter. If you want to buy foreign exchange, you can do it. It's like buying a loaf of bread. You don't have, it's not like a stock exchange transaction, right? You can virtually buy foreign exchange over the counter. Highly liquid. Market is very liquid. You can buy quantities in any amount, right? Because the foreign exchange market is as big as around $5.3 trillion a day. $5.3 trillion a day. Whereas in Sri Lanka, our foreign exchange transactions on a daily basis, on a good day, is about $100 million. And so compare the $100 million against $5.3 trillion a day. So Sri Lankan market is probably, well, it's actually not as liquid as some of the international markets, right? So now, for example, the yen or the sterling or the euro are markets, are currencies which are very liquid. You can buy and sell any amount, but the market does not really move. Huh? You buy billions, the market hardly reacts. So it has the capacity to absorb that kinds of volumes. Whereas in Sri Lanka, if a transaction is about $200 million, then it is a little difficult to execute the transaction. And you can't do it in one day because the market will react. It either, if you need to buy $200 million in one single day, the market will start shooting up because there might not be any sellers. Whereas if you start selling the $200 million, if you try to sell $200 million in one day, it might still be difficult. Because our market is not as liquid as some of the other markets. Right. So the markets are very liquid. Now having liquidity is very important because you can enter and exit at any time you want. So this is one of the concerns that foreign investors might have when they enter overseas markets. Right? A foreign investor who's coming in with $1 billion might want the ability, might prefer if the market is able to remit the $1 billion out whenever he wants. Right? So bringing in as well as taking out money should be easy. So that is one of the other concerns that foreign investors have. Because if the market is not liquid, they can take hits on the investment might be profitable. Right? Now, for example, if they invested in a company, in a local company, like let's say they invested in some kind of a let's say manufacturing plant in the country, or a hydropower plant in the country, and that plant gave them a 25% return. Right, so fantastic return for a foreign investor. But when they take the money out, now they'll invest in dollars, they bring dollars into the country, they'll convert the dollars into rupees, invest, and the rupee investment will earn them a return. Let's say the return is 25%. This return will have to be remitted to the overseas market. Right? So the issue the foreign investor will have is when it is being reconverted back into dollars and remitted out, they might take a beating on the exchange rate. Right? So if your return is 25% and you take an exchange loss of 40%, you effectively lose. Now, this is one of the things that you need to look at if you are investing in an overseas market. Exchange rates. And so that's why markets are not watertight compartments. Right? Equity markets will have impact on foreign exchange and vice versa. So this is how the market is structured. Most of the transactions happen during UK time, 41%, because UK overlaps between the US, the East, and the West. Right? When Japan closes, UK is open. And when US opens, UK is open. So it overlaps between these two markets. And the next largest happens in the US. Singapore is also quite large. And these are the major currencies, the G7s basically. Most of the transactions, almost 90% of transactions happen in the G7s. Right, so the euro, the yen, sterling, all those are part of G7s. The market participants, who takes part in foreign exchange markets? Right, we will have exporters and importers, people who export and import. Right. One thing I missed was, last week there was an interesting transaction. Right. Those who work for commercial bank will know. Others also will know that a certain party came and infused equity into commercial bank through a private placement, 125 million shares. They purchased 125 million shares through a private placement, and that transaction went ahead last week. They got shareholder approval. Sorry, it didn't go ahead yet, but the bank got shareholder approval. Right? So 125 million shares at 80 rupees. Commercial bank is trading at about 80 rupees right now, just above 80. It's 125 million into 80. It's about 10 billion rupees. A 10 billion rupee transaction happened last week. Who invested in commercial bank? Right, that is my question. What was the party that invested in commercial bank? Who was the investor? Any idea? Who invested in commercial bank? Very good. Fantastic. IFC invested in commercial bank. About 10 billion rupees. Okay, so 10 billion rupees is about what? $50 million. Yeah. So IFC is basically investing around $50 million in Sri Lanka. So this will have to be converted into rupees and then invested. Now, over the last couple of days, we saw the rupee adjusting downwards. It came to around 183. So this is perhaps in anticipation of IFC selling $50 million to invest in commercial bank. Right? So that is what can happen. Now, if this $50 million had happened, I told you that in Sri Lanka, the daily volume at best is about $100 million. IFC alone is bringing in $50 million. So that will increase volumes to about $150 million. And so that will test the market's ability to absorb the $50 million sale. It's not going to be an issue, but there might be an adjustment in the exchange rate. We might see it coming down a bit, right, when the sale actually happens. But if the market is very liquid, $50 million can be sold in no time and with minimal market impact. Hardly anything will happen. Sorry, Ezra. Disadvantages in what? The question is not very clear. Can you please clarify? IFC investing in Sri Lanka, any disadvantages? Well, actually, I think I would say it's a blessing, right? Because IFC is an institution, a renowned institution. It's an arm of the IMF. So when they invest, they do proper due diligence. And they're fantastic in terms of picking good investments. They pick and choose good investments which have potential. And the good thing is, one thing is they are bullish on commercial bank, which is very good. The other thing is they have confidence to bring money into Sri Lanka and invest, right? So now other investors will have confidence to follow IFC into Sri Lanka. They will feel that Sri Lanka is a safe place to invest. So bringing in $50 million is fantastic. It is definitely a blessing. But on top of that, what is more important is we can now reach out to markets and tell them that IFC has the confidence to invest in Sri Lanka. So y'all also please come and invest. Right? So IFC is investing because they have done all the due diligence. They are confident that Sri Lanka will do well. Right? So it's an opportunity for us to tap other markets. So we have to make a little bit of noise, inform the rest of the world that IFC is investing with us, and that will bring in foreign investors. Right? So it's actually a blessing. I would say it's good. Only thing is, when IFC invests, they come with lots of conditions, very strict in conditions, which is also good. Well, they come with so many strict conditions. Now, they might say that, I'm not sure, I'm just thinking aloud. They might tell commercial bank that they can only lend to certain sectors. They must avoid a particular sector, right? Maybe they might tell commercial bank to focus on the SMEs or micro sector and avoid the money that is pumped by IMF will not be lent out to high net worth individuals and corporates, something like that. They come with such conditions. Any threat to local competitors, meaning IFC investment or commercial bank being a threat to local investors, competitors, or local banks, you mean? Local banks, well, yes and no. Yes, because well, IFC is bullish on commercial bank, so that means they might, out of all the banks, they prefer to invest in commercial bank, right? Now, when that happens, commercial bank might find it easier to draw investors into it. And IFC is coming, so there is no more due diligence required. Any investor can come and invest in commercial bank. Also, any depositor, they can go on a bandwagon and tell all depositors that IFC has the confidence to come and give equity. So why not you all come and invest with us? You all come and deposit with us, give us your deposits. During a crisis, we are able to withstand it, and your money is very safe with us. So that's one thing they can do. They can make lots of noise. So investors who are concerned about the state of the economy, have concerns, might start withdrawing some of their funds from other banks. They might go for safety, for safer investments, maybe non-bank financial institutions. The deposits at those places might get pulled out, withdrawn, and might get deposited at commercial bank, right, at the expense of the return, because NBFIs also have been imposed with caps on interest rates. And when the interest rate differential is minimal, most investors, I assume, might want to invest in safer places if the interest rate differential is not that great. The other side is other banks might feel that commercial bank has done well to attract IFC, and IFC is already in the market, so they are familiar with Sri Lankan markets. They also might be able to build a case for IFC to come and invest in those banks. Right? So it can be seen as a positive for the competitors as well. Because if they're good enough, if they get that together, they also can be potentially very attractive to IFC or any other investor. Right? Not only IFC, there are other investors as well. Maybe large funds can come and invest. Right? Because just before the election, we saw lots of large funds exiting. Not this election, the previous presidential election. From that time onwards, before that, some of the large investors, the funds started exiting. Now that there is lots of political stability, these investors can be attracted, right? So other banks, other competitor banks have an opportunity to get these investors down for them. Because IFC has done the hard work, they have done their due diligence. It's a matter of other investors following them into Sri Lanka. So once they're in Sri Lanka, then it is up to each of the banks to attract investors. And it's a good opportunity for the country, golden opportunity. I hope that is clear. Apart from reputation of commercial bank, did IFC invest in Sri Lanka also due to holding a fair election? Unlike Belarus, there's political situation in the country, play a pivotal role in such scenarios. Absolutely, yeah. Political stability is an absolute must. Right? So it's a blessing that we have it right now. So definitely IFC will look at political stability. And also they'll have confidence that Sri Lanka, in spite of all the challenges, are now able to satisfy some of their foreign debt obligations, right? There will not be a sovereign default. There were concerns, that is why the sovereign yields shot up, but now everything is getting back to normal. All investors are bullish about the country. Yeah, so we have an exciting journey ahead of us. This is why all of you, it's important that all of you understand the subject, understand the economy, how the economy moves, where the world investment dynamics are changing. You all need to be abreast. Also, you all need to be qualified, so that lots of investors are coming into the country. There'll be lots of opportunities out there, and these investors will come, and as I said, they will pick and choose the best out of the best. And so it's important that you all have your qualifications in place, have your banking. If investors come and invest in banks, lots of opportunities will be there in banks. So it's very important that you get your qualifications as soon as possible, right? So don't delay. Do your exams and get through as fast as possible. Don't become a fixed asset to the institute. Although the institute might prefer it, don't become a fixed asset. Finish your exams as fast as possible and get yourself qualified. Right? The opportunities will present themselves, so you can make best use of them. Right. So let's move on. The participants, exporters and importers, right? Exporters are the people who will send goods overseas and they bring foreign exchange into the country. And so foreign exchange enter into a country through exporters and investors. Then importers are the ones who will take foreign exchange out of the country. And then banks, there'll be banks. All foreign exchange transactions are routed through banks. Authorized authorized dealers, maybe money changers. Now, not every transaction is electronic. Banks usually deal mostly with electronic transactions, not with very little with physical transactions. Physical currency notes do come to banks. Those need to be encashed, right? Also, there are a few non-bank financial institutions who are also involved in foreign exchange. They can maintain foreign exchange deposit accounts, foreign currency deposit accounts. There will be brokers who will link up buyers and sellers in foreign exchange. Investors and speculators, like the IFC, classic example. Speculators are the people who trade on foreign exchange fluctuations. Central banks, very important participant in the market. They decide on the optimal exchange rate for countries. Now, a central bank like the Federal Reserve, right? The US central bank is called the Federal Reserve. Japanese central bank is called the Bank of Japan. You have Bank of China. The objectives may be different, right? So the Federal Reserve might not intervene in the foreign exchange market unless there are abnormal fluctuations in the exchange rate. And Federal Reserve or the Monetary Authority of Singapore, they might target not the exchange rate directly. They might target maybe interest rates. Through interest rates, they might try to control the exchange rate within a certain level, desired level, a level that is decided by or in the best interest of the country. So they might not target the exchange rate directly. And so different central banks operate and in different ways. So this is how foreign exchange transactions happen. And foreign currency is brought in through an exporter. They will buy or sell the foreign currency to a certain bank, or maybe a couple of banks. And then when the bank gets foreign exchange, they will start trading amongst themselves. Foreign exchange transactions will get traded amongst different banks. And eventually, importers will buy some of the foreign exchange, and also the central bank, right, will intervene from time to time. Okay. Okay, so there are certain terms which you all should know if you are doing foreign exchange. Now, for example, some of these terms you all might already have seen. These are called the settlement dates, right? On the first day, there are 2 days in a foreign exchange transaction. One is called the trade date, the other one is called the value date. Trade date means the day the transaction happens. Okay, now, for example, if you all are deciding to get married, you decide to get married today, but you might not get married on the same day. It might happen somewhere down the line. The day you decide to get married is called the trade date. The day you get married, it's called value date. So you might decide today that you're going to get married next year by 31st December, or maybe by 31st December. Right, so today is the decision date. That's called the trade date. The day you get married is called the value date. Trade date is the date on which the transaction occurs, and the value date is the date on which the settlement takes place. Right? So the day you decide to get married is called trade date, and the day you get married is called value date. Spot date is 2 trading days, 2 working days after the trade date. If you did a transaction, let's say on Monday, spot date will be Wednesday. 2 days, 2 working days after the trade date. Now, when it comes, this is in terms of foreign exchange transactions, right? Spot date is the standard. All the exchange rate you see are spot rates. The rate that prevails 2 days after the transaction happens. So this happened because before SWIFT was introduced, the world was going on telex, right? So these messages, Morse codes had to be sent overseas, and it took time for these transactions to get processed. So they gave 2 days for the transaction to be processed and the settlement to occur. But when SWIFT came up, things started moving faster, and now you have same-day settlement. Right? The spot date is 2 days after today, after the trade date. Tom is tomorrow. 1 day, 1 working day after the trade date. Cash is the trade date itself. If the settlement happens on the trade date itself, it's called cash settlement. Anything beyond the spot date is called a forward. So that's how things work. Then there are 2 parties to a foreign exchange transaction. One is called the market maker. The other one is called the market taker. 2 persons, market taker and the market maker. Market taker and the market maker. I'll explain using an example. Right. So if you want to buy mangoes, let's say you go to a supermarket, right? You take, for example, Cargill's. If you want to buy mangoes and you go to Cargill's, who is going to quote the price to you? Will Cargill's quote the price to you, or are you going to quote the price to Cargill's? Who will decide on the price? If you want to buy mangoes, who will decide on the price? You or Cargill's? Yes, Cargill's will tell you that the price of a mango is 150 bucks. Right? So you can buy mangoes at 150 bucks. Then if you are a mango, you have a mango plantation. A plantation of mangoes, you grow mangoes. And you want to sell your mangoes to Cargill's. Again, who will decide on the price? Will it be you or Cargill's? If you want to sell mangoes to Cargills, who decides on the price? Because Cargills is big, most probably it will be Cargills again. As they will say, they will buy mangoes at 100. They will buy at 100 and they will sell at 150. And so Cargills will give you the price, they will decide on the price. Meaning Cargills is the market maker or the quoter. Cargills has quoted the price, they are the market maker. Whereas you are using Cargill's prices, their prices are being used by the customer. So you are the market taker or the asker. Right? So there are two parties to a foreign exchange transaction always. The market maker and the market taker, quoter and the asker. So the price that Cargills is quoting, 100 and 150. To make it simple, let's say Cargills is quoting one price. They are buying and selling at the same price. Cargills is the market maker. You are the market taker or the asker. Price of a mango, Cargills will say is 150 rupees. So this is the price of one mango. 150. The price of one mango in terms of rupees. Okay. So what you can say is the mango to rupee exchange rate is 150. Okay. This is called an exchange rate. That is the price of one currency in terms of another currency. Okay, so if the mango was $1 and in rupee it will be 150. This means $1 is 150 rupees. Yeah. Right. Simplest thing to learn is this is one mango is 150 rupees, right? So you are expressing the price of one mango in terms of rupees. No? The thing that you wrote first, right? In this case, the mango is called the base currency. The base currency. And you're quoting the price of a mango in terms of rupees. So the rupee is called the counter currency. Counter currency. Base currency and counter currency. So these are the two currencies involved. You have the base and the counter. So how do you identify the base and how do you identify the counter? Whatever the currency you write first is called the base. And the second currency is called the counter. Okay, in this case, the dollar is the base, rupee is the counter. Okay, that's very simple. So I hope it is clear. Base and the counter. This is the most important thing. The critical thing is you need to identify the base currency as well as the counter currency. Okay, so if you identify that, then foreign exchange is very easy. Which is why I said all of you should be masters in foreign exchange. Okay. Now, what if I say rupee against mango? Is this wrong? Is it wrong or right? Can I say 1 rupee in terms of mangoes. Is this expression correct or is it wrong? Is right or wrong? Rupee against mango. Can I write this way? Of course I can. Right. I can say 1 rupee in terms of mangoes. Now in this case, what is the base? What is the base currency? If I say rupee against mango, what is the base currency? LKR is the base. Very good. Whatever I wrote first is the base. This is the counter. So I'm writing 1 rupee in terms of mangoes, right? It will be the inverse of mango rupee. For 1 rupee, I get 1 over 150 mangoes. Yeah. So that's how the base currency and counter currency theory applies. Okay, so you're always quoting one currency in terms of another currency. Right. So any questions up to now? No questions? Okay. Now, if you watch news, you might see exchange rates being quoted in news, right? After news, you see, if you watch financial news, you might notice exchange rates being quoted. Normally, how are exchange rate expressed? You see $1 in terms of rupees or 1 rupee in terms of dollars. How are exchange rates quoted in Sri Lanka? Do you see $1 in terms of rupees or 1 rupee in terms of dollars? In news, if you watch news or in newspapers, yes, you will see $1 is 180 rupees. This is how exchange rates are quoted in Sri Lanka. Or the dollar rupee, in other words, is 180. Now, first question: which one is the base currency? Out of these two, which one is the base currency? Dollar is the base. Good. Right. So this is what we see now. Now we are quoting for us, right? For the Sri Lankan, which one is the foreign currency? Is it the dollar or the rupee? The foreign currency is the dollar, right? So we are quoting 1 unit of foreign currency in terms of local currency. Like 1 unit of foreign currency in terms of local currency. This is called a direct quote. It's called a direct quote. If we had quoted the inverse, right? The rupee against the dollar, which is the inverse of 180, 1 over 180, then we are quoting one local currency in terms of foreign currency. This is called an indirect quote. Right? If you quote one foreign currency in terms of local, it is a direct. It is called a direct quote. One local in terms of foreign is called indirect quote. Right? So direct quote and indirect quote. Simple question. If there is, if you see this exchange, euro to dollar, and euro dollar, there is no Sri Lankan rupee in between. No Sri Lankan rupee. This is called a cross rate. And so you have three kinds of quoting methods. One is direct quote. That's why you quote 1 unit of foreign against local. Indirect quote is 1 unit of local against foreign. Cross rate, there is no local currency involved. If there is no local currency, it's called a cross rate. So these are the 3 ways of quoting exchange rates. So I hope it's clear up to now. Direct quote is the number of domestic currency units per one foreign currency unit, or the number of domestic currency units per $1 in Sri Lanka, right? So if you are quoting 1 yen, for example, is 1.2 rupees, 1 euro, 140 rupees, $1 is 132.50 rupees. Okay. So you always remember, you're always quoting a unit of foreign currency in terms of local currency. That's called a direct quote. Indirect quote is the opposite. One unit of local against foreign. The number of foreign currency units per one domestic currency unit. The number of dollars per one domestic currency unit. Right. This is indirect quote. One local currency unit in terms of foreign currency units. Right. Now, there are certain countries like UK, Eurozone, Australia, New Zealand. They always say how much is their local currency in terms of foreign currency. They will say sterling to dollar, right? Sterling dollar. That means they're quoting 1 unit of their domestic currency in terms of foreign. That's called an indirect quote. Right. So theory is involved in foreign exchange transactions. First one is called purchasing power theory. Purchasing power theory. Purchasing power. Purchasing power. Now, if you take an identical product in two different countries, right? Incidentally, it is also called the Big Mac theory. Right? Big Mac theory. So that's why I said identical product in two different countries. Now, if you take the Big Mac in US, let's assume is identical to Big Mac in Sri Lanka. Right? So two identical products in two different countries. Let's say the price of the Big Mac in US, in Sri Lanka, let's say the price of Big Mac is 900 rupees. Big Mac, right? The burger is 900 rupees. Let's also say in the US, one Big Mac is $5. $5 US. Right? So you have the identical product. Let's say everything is identical. The size is the same, the quality is the same, the taste is the same, everything is the same. No difference at all. So the same product, price in two different markets will reflect the exchange rate. That is what purchasing power theory says. Now in this case, 900 divided by 5 is 180, which is the exchange rate of the dollar against the rupee. And the exchange rate of the dollar against the rupee. Okay, so this is what purchasing power parity means. Identical product in two different markets should reflect the exchange rate of between the two countries. Despite Japanese yen being regarded as a stronger currency, why there's a question. Despite Japanese yen being regarded as a stronger currency, why Japan yen is quoted as a relatively small value in rupees? Okay. Right. Why is the yen being quoted as a smaller value? So what you mean is Japan is a strong economy, but 1 yen is only about 1.5 or 1.2 Sri Lankan rupees. Why? About 10 years ago, the yen was actually less than 1 rupee. It was a few cents. Now it is almost 2 rupees. Right? A little over 1 rupee. Why did that happen? Well, it's not the exchange. You can't look at the exchange rate and decide whether the currency is strong or weak, right? Now, sometime back, the yen against the rupee was 0.9, 0.9. You can't look at this and say whether the country is strong or weak. It doesn't mean that. Right. For example, you take the stock market, right? The price of John Keys is 125. Then the price of, if I'm not mistaken, Swadeshi is around 50,000, something like that. So out of these two companies, I'm just throwing out examples. I'm not saying one is better than the other, but in terms of market capitalization, in terms of recognition, all that, market reach, which one is larger and which one do you think is better? Yeah, not to run down Swadeshi, no disrespect, but out of these two, John Case is better, right? So John Case is priced only at 125, Swadeshi is 50,000. Now, John Case, the number of shares they have issued is huge, massive. So many shares issued. Whereas Swadeshi has only a few number of shares issued, right? So that is why the price is so high for Swadeshi, because fewer number of shares issued. Whereas John Case has so many shares, issued number of shares, if you go into their balance sheet and check, it's massive. Okay, so you can't look at the price. The fundamental thing is you can't look at the price and decide that Swadeshi is better than John Case or that John Case is better than Swadeshi. It doesn't work that way. Right? If that was the case, then uh, 35 quadrillion, remember? That might look stronger than other currencies. Yeah. So it's difficult to decide, look at the exchange rate and decide whether currency is strong or weak. You have to look at fundamentals, economic fundamentals, like the amount of reserves a country has, the unemployment rate, GDP growth, mainly the amount of reserves that the country has, the amount of foreign debt, trade balance. There are other denominators. You can't look at the exchange rate. You can look at the exchange rate fluctuations. Okay, so the yen. About 20 years ago, I think it was around 1 cent. Just 1 cent. Not 20 years, maybe a little more. 30 years ago, 1 cent. Right. So today it is 1.5 rupees. So look at the movement from 1 cent. It has increased by how many times? This is about 1,500 times over a period of 30, 40 years. Right. Okay, so that's how it works. You can't look at the exchange rate and decide whether the country is a strong economy or a weak economy. Okay, Naglesh, I hope that is clear. Okay. Right. So getting back to purchasing power parity, an identical product in two different markets should reflect the exchange rate between the two currencies. Purchasing power parity estimates the amount of adjustment needed on exchange rate for the exchange rate to be equivalent to each currency's purchasing power. Exchange rate adjusts so that an identical good in two different countries has the same price when expressed in the same currency. Okay. So all you have to do is divide one exchange rate by the other. Now, my question is, if you have, how do you decide which currency is stronger? Now, let's do the example and then we'll get back to my question. So let's read this example and can you all try? Read this example and try. Give it a try. Simple question. Simple example for you all to understand purchasing power parity. Okay, so the question is, for example, a chocolate bar that sells for 1.5 Canadian dollars in Canadian city should cost $1 in US. When the exchange rate between Canada and the US is 1.5, right? So how does it work? An identical chocolate bar in Canada. Is Canadian dollars 1.5 in the US. It's US dollars 1. Now, my question is, out of these two currencies, okay, we'll get back to that. Sorry. What is the exchange rate? US dollar to Canadian dollar is 1.5 divided by 1, so it's 1.5. That is the exchange rate. Okay. So my question is, out of these two currencies, which one is stronger? Is the US dollar stronger or the Canadian dollar stronger? What are your answers? Simple question. Out of these two currencies, which currency is strong? The dollar is strong. Why do you say the dollar is strong? Reason? Why do you say the dollar is strong than the Canadian? High purchasing power. Okay. Price is lower, less inflation in the market. Okay. Any other reasons? Right. Now this exchange rate, right, is more than 1 or less than 1? The exchange rate is more than 1 or less than 1? In this case, the exchange rate is more than 1 or is it less than 1? Yeah, it is more than 1. Exchange rate is more than 1. Remember, if the exchange rate is more than 1, that means the base currency is strong. Right? Like exchange rate is more than 1. Then base currency is strong. If the exchange rate is more than 1, then the base currency is strong. Which means if the exchange rate is less than 1, base currency is weak. Now, why I asked you is, could this not have been 1 over 1.5? Then you will get 0.67. Why was it 1.5 divided by 1? Something you learned in grade 2. Right? Because you need 1.5 Canadian dollars to buy one chocolate. Whereas only $1, 1 US dollar to buy one chocolate, right? So to buy the same chocolate, you need 1.5 Canadian dollars. To buy the same chocolate, you need only 1 US dollar. That means 1 US dollar will buy you more. Okay, so dollar has to be strong. If the dollar is strong, dollar is the base currency, the answer you should get should be more than 1. So that's why it's 1.5 divided by 1. By any chance, if the Canadian dollar was stronger, then this would have been the other way. That's how it works. Okay, so there is only logic, there is no magic. I hope it's clear. All right, so let's move on. Interest rate parity, right? So we'll get back to interest rate parity later on. By the way, next week we'll be through a recorded session, right? So today is live, but next week will be recorded. And if you have any questions, you can direct them the week after. Yeah. All right. So let's move on with the next theory. Interest rate parity. We'll come back to interest rate parity. Using exchange rates in calculations. Shall we try these examples? Let's try the first one. Given the exchange rate of the dollar rupee at 132. If you have $10 million, how much can you get in rupees? If you have 100 million rupees, how much can you get in dollars? Right. So shall we quickly calculate? Can you all quickly calculate and tell me your answers? Okay, good. So the exchange rate is 132. Now, what is the base currency? Base currency. What is the base currency? Simple question. Base currency is the dollar. Right? So this is the base. And which currency is stronger? Dollar is stronger. Reason? Why is the dollar stronger? Why do you say the dollar is stronger? Because the exchange rate is more than 1. Very good. Yeah, it's not. Naglesh, it's not exactly whether the rate is high or low, but simply whether the rate is more than 1 or less than 1. Right. Good. So you have $10 million. $1 is 132 rupees. If you have $10 million, be 132 into 10 million. Then next question, if you have 100 million rupees, how much can you get in dollars? 100 million rupees in dollar terms should be more than 100 million dollars or less than 100 million dollars. It will be less than 100 million dollars because the dollar is strong, right? So if you had 132 rupees, it would have bought you $1 US. So 1 rupee would have bought you 1 over 132 US dollars. You have 100 million rupees. So it is 100 million. Over 132. Right? Which is 757,575.76. Okay, so I hope it's clear up to now. Any questions? No questions, so let's move on. Next question. Given the exchange rate of euro sterling 0.8585, so what is the base and which currency is strong? The base is euro. Sterling is stronger. Why do you say so? Euro is the base. Sterling is stronger because the exchange rate is less than 1, right? So base currency is weak, meaning sterling is strong. Given the exchange rate of 85 euro sterling, you have 10 billion euros. How much can you get in sterling? So 1 euro equals 0.8585 sterling. You have 10 million euros. Okay. Then you have 10 million sterling. How much can you get in euro? 0.8585 sterling will buy you 1 euro. So 1 sterling buy you 1 over 0.8585 euro. Question is, you have 10 million sterling. It's 11, 648, 133, 5, 65. Okay, so I hope it's clear. Any questions up to now? No questions, so let's move on. Say the price of a mango 1 month ago, last month, the price of a mango, 1 mango is say 100 rupees. In other words, mango against rupee is 100. So what is the base currency? Base currency in this case, if the mango rupee is 100, the base currency is the mango. So let's say this month the price is 150. From 100 it has gone up to 150. So this means which one has strengthened? Has the price of the mango strengthened or the rupee strengthened? If the price of a mango goes from 100 to 150, which one strengthens? The price of a mango strengthens, right? Which means the rupee has weakened against the mango. But if it goes not to 150 but to 50, then the mango has what? Strengthened or weakened? Has weakened. Okay. So if the price goes up, that means the base currency has strengthened. The price goes down, price comes down, it means the base currency is weakening. Right? On this example, dollar rupee 132.20, it has gone to 132. $32.20, it has come down to 132. This means if the rate has come down, the base currency has weakened. So the dollar has weakened. Rupee has strengthened. And so the rupee has appreciated, dollar has depreciated. What percentage? By 20 cents. That gives you the percentage movement. Next example, sterling dollar 152.50 goes to 152. So what is the base currency? First currency, that is the sterling, is the base. The exchange rate has gone from 152.50, it has reduced to 152. That means the base currency has weakened. Right? Base has weakened by E divided by 152 into 100%. By 50 basis points, it's called. Right, so I hope this is clear. Right, so let's go back to the Cargills and the mango example. Cargills was the market maker, if you all could recall. And they will buy mangoes from the plantation at 100, right? They are the market maker or the quote. They will buy mangoes from the plantation at 100. Then they will sell mangoes to customers at 150. Okay, so they are buying is the mango against rupee. You're looking at the mango against rupee. They will buy this at 100. They will sell it at 150. So if you go to Kargil's and you want to buy mangoes, they will sell at what price? 150. And if you want to sell, they will buy at 100. Okay. They will not do the reverse, no? So if they buy mangoes at 100, sell at 150, they will make a profit of 50 bucks. Okay. So the price at which the market maker buys is called the bid. They are bidding for mangoes at 100, and the price that the market maker is willing to sell the underlying is called the offer. Remember, you're always talking about the base. Right? You're looking at the base. The market maker will buy the base at 100, and the market maker will sell the base at 150. So this is the bid, this is the offer, bid and offer. It's called bid and offer. There will be two prices in the market. One is the bid, one is the offer. Bid is the rate at which the market maker is willing to buy the base currency or sell the quoted currency. Offer is the rate at which the market maker is willing to sell the base currency or buy the quoted currency. Right. And then the difference between bid and offer. The offer minus the bid. So it's 150 minus 100 is 50. This is called the spread. Spread is 50. Offer minus bid is called the spread. It's 50. That is the profit that the market maker makes. Profit, assuming the market does not move, the profit they will make by buying and selling is called the spread. It's 50 in this case. Yeah. Right. Now let's assume Kargil's makes only a few cents, right? Let's say they're buying mangoes at 100 rupees 10 cents. And they're selling mangoes at 100 rupees 20 cents. Now what is the spread? They're buying mangoes at 10 cents, 100 rupees 10 cents, and they're selling at 100 rupees 10 cents, right? So the spread is 100 rupees 20 minus 100 rupees 10 cents. They make a 10 cent spread. So if they were in the mango market, they will only quote the last two digits. But only the last two digits will be quoted, 10, 20, they will quote. So what they mean is they're quoting only the last two digits or the decimal points in this place, only the number of cents, 10 and 20. So this is the bid, this is the offer. So what it means is, if you are in the mango market, you should know what this part is. This part you should know, it's called the bid figure. The last two digits are called pips. So what is quoted are only the pips. They will only quote pips. They will just say 10, 20. If you are in the mango market, you should know the big figure. Right? Traders are supposed to know the big figure. Only pips are being quoted in markets. That is how markets will quote a price. They will only quote the pips. That is what is mentioned here. Spread is the difference between the offer and the bid, the income for the price maker. Right now, so in this example, the euro dollar example, it says 1.3275. Right, so the last two digits, in this case 75, are called the pips. And this is 1.32 is the big figure. Right. So remember, in the market only the pips are being quoted. Now this is how a foreign exchange transaction happens. Right. Now if you go to the bank, forget about foreign exchange, just go to the bank, and if you want to deposit $100, you have to fill in a slip. You have to sign it, take it to the cashier, give it to the cashier might have to get some approvals. If you want to withdraw 100 rupees, they might have to get some approvals from the authorized officer, and then only you get the $100 back. Right? So there is lots of documentation. Now this transaction is a foreign exchange transaction. Let's see how it takes place. If you all have done chatting on maybe WhatsApp, Viber, or any other platform, this is something that you would have done, right? Your conversations would have looked like this. Okay, so let's say now this is a transaction that is happening between two traders, right? So let's go to the top one. He's buying 5 million at 0.9917 Aussie US dollar. 5 million Aussie dollars has been bought at a price of 99.17. So let's see what happens right now. When the transaction happens, the guy in black, he's asking for AUD 5 million. What he means is AUD against US dollar. He's asking for a price of 5 million. And so Australian dollar in this case is the base currency. So this Sven is quoting a price of 15.17. Remember, these are the pips. So only the pips have been quoted. They have said 15.17. Bid is 15, offer is 17. The Nalika says, I buy. What on earth is she buying? She's buying Australian dollars, right? She asked for Australian dollars, now she's buying Australian dollars. If she's buying Australian dollars, she'll have to buy at the offer. Remember, Apple's Cargills will sell. Cargills is a price maker. They will sell apples at the offer. This case, Sven is the price maker. He will sell, let's say this is also apples. He will sell apples at the offer at 17. Right? So instead of apples, he is selling Australian dollars. He will sell Australian dollars at 17. So Nalika has bought at the higher price at 17. And Sven says, now Sven has sold Australian dollars. So if he sells Australian dollars, he's receiving US dollars. So he's asking Nalika to deposit the US dollars to JP Morgan Chase, New York. He's giving account details on 31st January. That's a value date. This is VAL is not val, it means value. Right? Value date 31st January 2011. Then Nalika is confirming. To confirm, she is saying she is buying 5 million Australian dollars at a price of 0.9917. The value 31st January 2011. So she has bought Australian dollars and she is telling to transfer the Australian dollars to the Reserve Bank of Australia on 31st January 2011. So that's a foreign exchange transaction. That's how it happens. Simple chat. And it's closed. Right? So the amount, huge amount. Not the 100 rupees that you wanted to withdraw from your account. It's a huge amount, 5 million Australian dollars. takes less than 10 seconds to complete. Right? Because all these are programmed, you just only have to enter the currency, the amount, and everything else is automated. Right? You just have to press a few keys. Okay, now in this case, Nalika has bought 5 million Australian dollars. Right, so 5 million Australian dollars she's buying at a price of 0.9917. So what amount of US dollars has she got to pay? Sven has quoted a price of 1517. These are the pips, right? Pips, and the big figure is given as 0.99. Right? So this means 0.9915, 0.9917. So these are the price of mangoes. Nalika wants to buy mangoes. She will be buying mangoes from Cargill's at the higher price. 0.9917, the price of Australian dollar against US dollar. So 1 Australian dollar, 0.9915, 0.9917. She is buying Australian, right, at the higher price. So 5 million Australian dollars if she is buying, 0.9915 into 5 million, or 0.9917 into 5 million. So she is buying Australian, she is buying mangoes, that is the amount she will have to pay, 0.9917 into 5 million. That is the US dollar amount. Right, so this much of US dollars, which comes to $4.9585 million US dollars, she will have to give to Sven. Right, she will be transferring this on 31st January to Sven's account at JP Morgan. Right. In turn, Sven will be delivering the 5 million Australian dollars to Nalika's account at the Reserve Bank of Australia. So this is how foreign exchange transactions happen. Right. So I hope everything was clear up to now. We will have to stop at this for today. And next week we will meet through a recorded session. Okay, which currency is the base? Which currency is the base? AUD is the base, right? AUD is the base. And which currency is stronger? Australian is stronger, US is stronger. Australian is weaker, right? The exchange rate is less than 1, meaning the base currency is weak. So if the base currency is weak, Australia is strong. Base currency is weak, meaning the Australian is weak, so the US is stronger. Right? Base currency is weak because the exchange rate less than 1. Okay, Ezra, that's clear? Right, so we will meet next week through a recorded session. It will be a continuation of where we stopped today. And if you have any questions, you can ask on the 29th. Thank you very much. Stay safe.